Hello, everyone. Welcome to the TDWI webinar program. Thank you for joining us today. My name is Linda Briggs. I'm a contributing editor at TDWI, and I'll be your moderator. Our program today is BI for Finance, transforming the finance department from record keepers to strategic advisors. We have several sponsors of today's presentation. They are MicroStrategy, Oracle, Teradata, and Visual Mining. And we have an excellent speaker lined up for you today, our own Wayne Eckerson, who is Director of Research here at the Data Warehousing Institute. Before I turn the time over to Wayne, let me go over just a few basics. First of all, today's webinar is going to be about an hour long. At the end of the formal presentation, we're going to host a question and answer period so that you can ask Wayne any questions that may have come up. If at any time during the presentation you'd like to submit a question, just go ahead and type it in using the Ask a Question area there on your console and hit Submit, and we'll be answering those questions in the final portion of the presentation. If you do run into any technical difficulties during the webinar, there's a help area there below your slide window. You can click on that for technical assistance. To display a larger version of slides during the presentation, there's an Enlarge Slides button there as well. And if you'd like to discuss this webinar on Twitter with hundreds of other attendees, you can do just that. Be sure to include #TDWI as your hashtag in your tweets. And finally, if you'd like to download a PDF copy of today's presentation to your desktop immediately, use that Click Here for PDF button on the left middle of your screen. In addition to that, we will be emailing each of you a link to an archived version of today's webinar, so you can view the presentation again. We are recording it as well, so you'll be able to listen to it as well. Also, if you'd like to share that link with colleagues, you can certainly do that. Okay, again, today's presentation is BI for Finance, transforming the finance department from record keepers to strategic advisors. Our speaker today is Wayne Eckerson, who is the Director of TDWI Research at the Data Warehousing Institute. Wayne is an industry analyst, consultant, and educator who has served the data warehousing and BI community since 1995. Among his numerous published works, he is author of the best-selling book, Performance Dashboards, Measuring, Monitoring, and Managing Your Business. He's also the author of TDWI's BI Maturity Model and Assessment Service, which enables organizations to benchmark their BI programs against industry norms. Wayne speaks frequently at industry events and works closely with BI teams to optimize the agility and value of their BI initiatives. Wayne, I'll turn the stage over to you here.
Thank you, Linda, and welcome everyone who's on the phone today and online. I have a packed agenda here, and I'll put it up on the screen. First of all, we're going to just talk about the evolving role of the finance department, where it's been and where it wants to go, and then talk about the role of BI in the transformation process that many finance organizations are undergoing today. We'll talk about the reality and obstacles in leveraging BI to transform finance to become more strategic providers to the business. And then at the end, I'll go through 6 best practices for applying BI to finance to achieve those transformation goals. So, imagine a future in which the CEO calls a meeting of finance, sales, and other unit heads and their analysts, and everyone agrees on revenue, profit, and cost numbers. And the team spends the meeting identifying issues of concern, discussing options, and agreeing on corrective actions. Imagine a future in which a CFO who checks the company's overall profit and loss position daily, and with a click of the mouse can view the contributions of every region, group, and product line, and then drill down to view individual orders and expenditures at a product, customer, or supplier level. Imagine a future in which a vice president of finance can assess at a glance the company's progress towards achieving strategic goals at all levels of the organization and drill down to view performance of any group, region, or area without IT's assistance. Imagine a controller who can automate the consolidation and standardization of financial transactions across a global company in a few seconds and generate period-ending statutory reports in a few hours or days. And finally, imagine a financial analyst who can go one place to find all the information he or she needs to conduct an ad hoc analysis for an executive, or who can generate a standard report without having to perform countless conversions using custom rules and macros in unaudited and error-prone spreadsheets. Now, these scenarios that I just described may seem fanciful to some of you, but they really are at the reality of an increasing number of companies in which the finance department has transformed itself from a back-office provider of accounting services to a strategic advisor to the business. Effectiveness and efficiency are the two dimensions by which the Hackett Group measures companies to determine world-class finance organizations, as seen in this chart. Efficiency means doing things right, such as driving finance costs to the lowest level as a percentage of revenue, whereas effectiveness means doing the right things, such as finance taking an increased role in supporting decision-making activities within company operations. Increasingly, efficiency and effectiveness enable finance departments to move up the food chain from serving as clerks all the way up to strategists, as seen here. Now, to facilitate this metamorphosis, forward-thinking finance departments have re-engineered the way they handle information, treating it as a valuable corporate resource that not only paints a picture of the past, but paves a clear path to the future. Now, historically, the finance department has kept the books, managed the budget, and looked after cash, capital, taxes, treasury, and statutory reporting. But in an increasingly competitive global economy, there is less tolerance for people and processes that don't add direct value to the organization. So, like other shared services, for example, IT, human resources, there has been a very strong movement in the past decade to transform these shared services functions into more active contributors to the bottom and top lines of the organization. So today, finance can and should get involved in helping the organization identify its key value drivers, and then work with the businesses to re-engineer processes, recommend investments in capital, companies, and people to expand all these areas. But doing this requires a lot of information and analysis, so savvy finance departments are increasingly implementing dashboards and scorecards, continuous planning and budgeting solutions, better forecasting tools, and applications that calculate customer profitability and predict churn, among many other things. So in short, is finance in the engine room or the caboose? Does finance want to be an accountant or advisor, a bookkeeper or savvy strategist, a cost center, or a profit center? I think the key in achieving this transformation is going to be, in large part, business intelligence. For the past decade, a lot of CFOs have recognized the importance of transforming their departments, and this is what I've heard a few key CFOs say. We need to change from being a financial record keeper to a proactive partner with the business. I heard another say, quote, I want the finance group to do more than accounting. I want them to help the company make profitable decisions. And another said, quote, we need to collaborate with the business if we are going to improve the financials. Showing them actuals and targets isn't enough. We need to help them re-engineer fundamental processes. Forward-thinking finance departments collaborate with business managers on a range of issues that ultimately drive financial performance. For example, they can help managers figure out how to optimize pricing, reduce the inventory costs without affecting revenues, rationalize sales commissions, improve the profitability of merchandise assortments, reduce cost center costs without impacting service, and streamline provisioning and procurement process, among many other things. Finance might also help the business evaluate whether to extend store hours, source parts from a new supplier, merge with another company, or take on a new partner. Finance can be a powerful agent of organizational change. That's because it sits at the information nexus of the organization. Information is the currency of finance, which enables it to do all those things I just described. It collects financial and non-financial data from every business unit and department throughout the organization on a regular basis and creates summary and detailed management reports of activity. But to add real value, finance needs to move beyond basic data collection and reporting. It needs to mine the voluminous amount of information it collects for trends and patterns and anomalies. And armed with these insights, finance can start to advise the business strategically and operationally. When you examine finance departments that proactively advise the business, they have at least one thing in common. They've standardized financial information throughout their organization and harmonized it with detailed transaction data used by the business. This provides a consistent set of information that both finance and business unit managers can use to understand past activity, forecast the future, and make important decisions. This so-called single version of truth liberates the finance department to focus on value-added activities that drive business performance. One BI director told me, quote, "Our finance community has been a big proponent of a single version of truth and enterprise business intelligence because it has helped them undergo a major transformation. Our finance team now spends 80% of their time analyzing data and providing value to the business and 20% of their time collecting it instead of the other way around, which is what it used to be at this organization. And in fact, many other organizations that I talked with. When finance actively partners with the BI team and delivers a single version of truth that is usable by the finance department, and that's a big caveat, a lot of good things can happen. One, analysts spend less time collecting and massaging data and more time analyzing it, which leads to better insights, better models, better forecasts, and scenarios. BI aligns the business by delivering consistent definitions, rules, metrics, essentially a common vocabulary that ensures everyone is speaking the same language. BI also improves understanding of customer and product profitability, the impact of pricing on revenues and profits, and so on. So companies can adapt more quickly and appropriately to changing business conditions and avoid making costly decisions. Executives also get fewer surprises because proper controls for managing financial data have been implemented, and they avoid the awful specter of having to go to jail because the appropriate data controls were not in place. So let me give a few examples. One is Office Depot, which built an enterprise data warehouse that aligns financial and product data at a detailed level. By merging financial and product hierarchies in data, Office Depot now has a common language that enables finance and merchandisers to communicate about product profitability and figure out ways to improve it. For example, in the company's copy and print center, financial analysts using a variety of BI tools noticed that black and white copiers weren't generating as much profit as color copiers, and they then worked with the appropriate business managers to shift their inventory to color copiers and improve store profitability. In another instance, financial managers noticed pricing discounts were edging higher than expected in several locations and notified the appropriate managers to take action. Says James Hogeson, Director of Sales, Accounting, and Reporting at Office Depot, quote, "In the past, finance had its profit loss statement and merchandising had its sales and gross margin reports by product, but the two weren't connected. Now both groups can see the profitability of individual products on a daily basis, which has enabled the business to change its strategies more quickly." The finance department at AT&T Mobility has benefited from having a single version of truth delivered via enterprise data warehouse, which now calculates the profitability of all 80 million of its subscribers on a daily basis. Consequently, financial analysts can outperform detailed analyses more quickly and accurately than in the past. Says the director of financial analysis at the company, quote, "If you lost 1% of your customers yesterday, wouldn't you like to know today who they are and whether there might be a common thread behind that churn? With the data warehouse, we can pinpoint those subscribers and work proactively to win them back. 10 years ago, we made assumptions on samples of data and based our decisions on gut feel or someone's ability to argue an opinion. Now we have a lot more precision." So today, the finance department at AT&T Mobility doesn't spend a lot of time fact-finding and guessing because it already knows the facts on the ground out in the marketplace. It focuses on working with the business to figure out the levers to pull to make an item on the income statement go up and down. The finance department now understands operations and the drivers that lead to higher revenue and lower cost without degrading the customer experience. So finance really, through information, has figured out what levers to pull to improve different lines on the income statement. When an organization's data house is in order, it can deliver an integrated view of the enterprise from both a financial and operational perspective, as we've just heard, with great business impact. So this chart depicts the information ecosystem for a finance department and lists many value-added analytic applications that a BI environment supports. As you can see, starting at the bottom, data flows from source systems, the run-the-business systems, into a data warehouse that harmonizes the data using a common corporate vocabulary, definitions for key terms, key metrics, and things like that. From there, users have access to the information via a variety of reporting and analysis tools, as well as higher-level applications that incorporate these tools. The most common analytic applications used by finance departments are financial reporting and consolidation, planning and budgeting, performance management via key metrics, 360-degree views of customers, products and suppliers, analytical models, predictions, and profitability and risk management applications. And on top of these sit functional and vertical specific instances of these applications, essentially applications that embed BI and its tools within them. Now, as you can see, this is a big house, a building complex, if you will, and it doesn't get built overnight. In fact, it takes many years and in often cases many false starts before it's erected and stable. Now we're going to go through some of the obstacles, and this chart shows that most organizations do have a long way to go before they can achieve a BI nirvana, or that single version of truth. The chart comes from a survey of finance and BI professionals that I conducted as part of this study. The bars in the chart reflect respondents who said the statements that you see in the chart applied to their finance department to a high degree. The chart also shows that finance and BI professionals see things the same way for the top three statements, but diverge on the bottom three. A majority from both sides agree to a high degree that their finance departments, quote, do most of their work in Excel, spend too much time collecting and integrating data, and would like to rely less on IT to access and analyze data. The two groups diverged on statements that finance, quote, is focused more on reporting than analysis, can't align financial and operational data, and has difficulty reconciling reports. However, less than 50% of respondents agreed with most of these statements to a high degree. So there is some difference at the bottom there, but overall, I think we can say that most people agree that there's a lot of work left to be done in these areas. By the way, there is a link on our website provided by one of our sponsors that will enable you to slice and dice all the data from this survey interactively, just using your web browser. Now, this chart is based on questions that asked respondents to cite both the importance of an analytical process to the finance department and how effectively they are implementing it. Responses are based on respondents, again, who rate the importance or effectiveness as high or very high. As you can see, there's a large gap between how important an item is and how effectively companies are implementing it. Items of most importance to the finance department from left to right are statutory reporting, delivering consistent information via reports, budgeting and planning, compliance and controls, performance visibility and transparency, and strategy management via scorecards. The chart shows essentially that finance departments are most effective at statutory reporting and compliance and controls, but less effective with the others. No surprise there. And overall, there's a big execution gap, if you will, between something that's important to them and how effectively they're implementing it. So we have a lot of work to do to get finance to the point where it needs to be to use information to transform itself. This chart plots the execution gap for BI tools and analytic applications. As you can see, most respondents feel there's a big gap between how important a tool is and how effectively the finance department is implementing it. No surprise that spreadsheets are the most important tool for finance on the far left, and it's far more effective in implementing spreadsheets than any other tool or application listed here. Although I will say there's still an impressive gap between importance and effectiveness even for spreadsheets, which does make sense. Now after spreadsheets, the order of importance to finance departments is financial reporting, budgeting and planning, ad hoc reporting, data warehousing, modeling and forecasting, analysis or OLAP tools, profitability management, dashboards, and data mining tools. It's a little bit depressing for me to see that data warehouses are as far down the importance list for finance as they are. Obviously, if delivering a single version of truth is critical to finance's ability to transform itself, we need to improve that score. If we just talked about spreadsheets, I think it's appropriate for me to talk about spread marts, because you can't talk about finance BI without talking about spread marts, which essentially are spreadsheets on steroids. Spreadsheets functioning as renegade data marts or essentially data management systems, which is really not what a spreadsheet was originally designed to do. A spread mart is created essentially by financial analysts who populate it with data they collect and transform it with the rules they define. I often call these human data warehouses or analytical silos. And they wreak all kinds of problems on organizations. The most famous is the one I mentioned at the outset, the dueling spreadsheet phenomenon, or at least intimated at the beginning, where all executive meetings degenerate into arguments over whose spreadsheets contain the right data. There are many dangers with spread marts listed here. First and foremost, they undermine data consistency and lead to a fractured view of the business. In addition, business analysts not schooled in SQL and database technology may create poorly formed queries and deliver inaccurate data. They may improperly merge two data sets, make a data entry error, or apply the wrong macro, or create an error when creating that macro. So bad data leads to bad decisions. In addition, spread marts are not adequately stress tested, validated, or backed up, and few can scale to support the enterprise. They often lack adequate audit trails and controls, leaving an organization vulnerable if the analyst leaves the company and takes the knowledge of how the report was created with them. But finally, perhaps most importantly, and we've already alluded to this during the session, business analysts spend an inordinate amount of time creating and maintaining these spread marts when they could be doing other more value-added activities. Our research shows that the median cost of spread marts per organization is $780,000 per year in lost time, and this is a conservative estimate. I've seen many companies justify the creation of an initial data warehouse by simply calculating the amount of time it would save their business analysts from handcrafting these spread marts. So if we're not going to use spreadsheets, obviously we want to use business intelligence tools, but these are not necessarily a panacea either for the finance department, although we've made great strides in meeting their needs. Often financial analysts just can't make them work for what they need to do, and a lot of it depends on the data that they're trying to access. So let me quote one financial analyst who, by the way, recently changed from becoming a financial analyst to a BI manager and is now experiencing life from the other side, with equal frustration, I might add. So she says, quote, "When I was in the planning and forecasting role in finance, the BI team would generate a report that gave me 90% of what I needed. Although they felt they had addressed my needs, this was almost useless to me, as I would need to rerun my manual queries to get the 10% of data that was missing. I have been one of those so-called spreadsheet jockeys, not out of an affinity for Excel, but out of necessity. Finance is under tight time pressures to crunch the numbers and provide recommendations to the business. Major decisions are made on these recommendations. such as whether to take or reject business or do layoffs, the finance team can't afford to be wrong or wait for the data to be in the right format. The reason that Excel is used is because this tool is the only place where you can download BI reports that meet some, not all of your needs, and then adjust in our link, i.e. integrate the numbers accordingly. So this is a common phenomenon out there, and it's one reason why it's hard to bring the finance department into the BI data warehousing orbit. But that being said, I found many organizations that have eliminated their dependence on Excel as a data management and reporting system while continuing to use it as an analytical and planning tool in quite effective ways. So now let's talk about best practices. How do forward-thinking finances use BI to transform themselves into strategic advisors? Well, I've boiled down the techniques that I came across into 6 best practices, but I'm sure there are many, many more. And I'd love to hear from you if you have any other ideas about how to transform BI, transform finance with BI. The first is sponsorship. For the finance department to serve as a partner and advisor to the business, it needs clean, integrated, and consolidated data. I think we've made the case for that. But there is a chicken and egg dynamic here that prevents finance from getting what it needs. On one hand, finance can't wait for the BI team to deliver consolidated data, but on the other, the BI team can't deliver consolidated data unless the finance team agrees to help it. So how do you break this vicious cycle? How do you get the finance out of the data management business and into the data analysis business? Well, it starts at the top. The CEO and CFO must be committed to change and be willing to make the tough calls to fund transformation initiatives that replace hand-cobbled reports with automated ones and reorient financial managers and analysts to higher value activities. But these leaders usually don't deliver such commitments until they've experienced significant pain from lack of high-quality information. So oftentimes you have to wait for the pain before you can make the case. Once they've felt the pain and they've decided to make a commitment, then the executives need to fund and evangelize the BI initiative, and most importantly, need to stick with it long enough for it to bear fruit, because it takes many months, if not years, to implement self-service BI tools and to fully populate the data warehouse with enterprise data across all the subject areas that finance needs to pull information from. So this requires a significant investment of time and money and requires sustained sponsorship to bring it to fruition. Perhaps most importantly, once the system is implemented, executives need to use the darn reports that were generated from the warehouse and the BI tools and not give in to the temptation to use the spread marks that their trusted analysts are creating or have created for them historically. Dave Whittington of AT&T Mobility said, quote, once our CFO started certifying the metrics, sales and marketing were forced to use the same numbers. If they didn't, they would have to explain why the numbers didn't match the CFO's numbers, and that is a discussion they didn't want to have. The second best practice is partnership. The basis of any partnership is respect. So it's imperative that both the finance department and the BI team understand and respect each other. This means taking time to really understand the stresses, pressures, and demands that each group has on itself. Greg Thompson, Director of Financial Systems at Office Depot, says, quote, in my group, we are joined at the hip with the BI team and have come to respect the abilities of each other. In the beginning, there was uncertainty, but the BI team has learned a lot about finance and what we need, and we've learned a lot about systems and that we also need to prioritize what we do so we only ask for what we really need at the time. One way to foster a partnership is proximity. In my experience, the best projects have a one-to-one mix of business and IT on the team, and they sit close to each other in the same cube block, if not the same room without cubes, everybody in one big room so everyone can see each other. The worst projects had groups separated by buildings or oceans. It just doesn't work. The easiest way to form a partnership, however, is for the BI team to recruit people from finance who know the business, the data, the people, the idiosyncrasies, and its processes. Part of Office Depot's success has been due to the fact that its senior director of IT and senior manager of BI both came from finance and know how to communicate with finance professionals. So astute BI managers are always on the lookout for technically savvy finance staffers to bring on their team. Third best practice, empower financial analysts. Many BI professionals iterated the importance of making financial analysts an extension of their team and capabilities. They can be the eyes and ears of the BI team within finance. They are subject matter experts that the BI team relies on to interpret source data, review target models, identify requirements, and understand data defects and what to do about them. So instead of putting them out there as the enemy, we need to incorporate them on our team. In addition, the BI team should recruit a financial analyst in each business unit to participate in the working committee of a BI competency center. They can be instrumental players in creating the corporate vocabulary, defining architecture standards, prioritizing projects and applications, and evaluating and selecting BI tools. Now, the BI team should view the spread marks that the financial analysts create as actually instantiations of business requirements. So rather than squash those spread marks, they should embrace them and work to make the financial analysts who create them loyal advocates of the data warehouse. A.J. Pictionary says, quote, "You need to recognize that financial analysts are in the BI business, so make them part of the team and support them. Otherwise, they're going to go off and do their own thing." BI teams should also empower financial analysts with the best analytical tools possible, besides Excel, and give them wide access to data. This often involves creating dimensional cubes for them to work on, or analytical sandboxes within the data warehouse. It lets them merge enterprise data in the warehouse with their own data that they can upload to it. To succeed with finance, the BI team must make sure that financial data in the warehouse conforms to the way finance wants to see it, with all the adjustments, accruals, and normalizations applied to the data. In other words, we need to create a finance-friendly data warehouse, which is our fourth best practice. Now, this takes a lot of time and effort and requires financial analysts to team up with the BI team to hunt down and fix errors and inconsistencies in the data warehouse. As Dave Whittington says, quote, "Our data wasn't very accurate when we started building the warehouse. We had teams shore up countless business rules and transformations so the metrics wouldn't leak, that is, generate errors, but now we have a pretty tightly wound process." To merge financial and transactional data, the BI team must design the warehouse so financial hierarchies in the chart of accounts link to product hierarchies using common keys. This linkage in the data model enables users to traverse the two worlds, navigating between sales, invoices, and expenses and monthly financial results. So we're physically linking those two worlds together through keys in tables in our data models. In addition, the data must be captured and stored at the transaction level so analysts can dive into the details. Even if finance requests summary data, the BI team should be ready to deliver the underlying details because financial analysts and CFOs and financial managers will always have follow-up questions. This atomic level data is also required to support profitability applications where costs are allocated across various accounts, products, and customers. The data warehouse also needs data from all business units and functional areas to be useful to the finance department, as I said earlier. If any data is missing, the finance users must go get it, which cycles them back into using spread marks and wastes time and money. In addition, the data needs to be updated frequently, usually daily, for most data elements, if not more frequently. Timely data enables financial managers to work proactively with the business to solve problems. So our fifth best practice is consolidate and harmonize. One problem that bedevils finance and BI teams is that most companies have multiple general ledgers running on different platforms using different charts of accounts due to successive mergers and acquisitions, or the fact that the business units are quite autonomous and have the power to select their own applications. So one way to fix this mess is to integrate the data after the fact, basically accepting that you've got a heterogeneous environment out there and we'll fix it on the back end. And this can be done by data integration tools that populate a data warehouse, reporting tools that join data dynamically from multiple sources, or manually via spreadsheets, at least for the reporting and analysis part of the business. We can use those types of tools. Now, another popular option is to use financial consolidation and reporting tools, which a lot of finance departments do, which merge data from multiple general ledgers, handle currency conversions and intercompany eliminations, and convert data to various accounting standards, such as GAAP or IFRS. These tools can collect and consolidate financial results from disparate general ledger systems with different charts of accounts, but they would actually work better when the account structures and general ledger software at each business unit are the same. So, given all that, that's pretty complicated to take this mess in the back end and try and filter it, standardize it, and turn it into one. So, perhaps the ideal way to integrate general ledger data is not to have to do it at all. This can be done by standardizing on a single financial ERP package and chart of accounts. Although this is an expensive transformation, it significantly reduces the amount of integration work that a financial analyst, a data warehouse, or BI tool has to perform after the fact. In addition to a standardized general ledger, organizations need a shared vocabulary so everyone knows what each other is saying when they use basic terms like customer, revenue, expense, cost, and profit. Standardizing terms doesn't mean that the company has one definition for sales or profit, although this would be nice. A more realistic option is to standardize on a few definitions and apply different labels to them. So, fifth best practice is to consolidate and harmonize our data and definitions. And finally, as we've alluded to already, it's really important to manage Excel. Although Excel is the tool of choice for creating spread marks, that doesn't mean BI teams need to eradicate it from the organization. As I said earlier, Excel has its place as an analysis and planning tool. Most financial analysts already know how to use it, and it comes bundled with Microsoft Office, making it inexpensive and ubiquitous. But the key is to use Excel as an analytical tool, not an enterprise data management system, which is where you would get into trouble with it. So it's imperative that the new BI tools that you bring to bear as part of your BI and data warehousing initiative empower both casual and power users. Casual users need self-service navigation tools such as parameterized reports and dashboards, interactive dashboards, while power users need a lot of ad hoc capability, ad hoc report creation tools, as well as multidimensional OLAP tools, and perhaps some new in-memory visual discovery types tools. It's also important to replace spread marks with a combination of BI tools and a data warehouse. However, if people are too attached to those spread marks, what you have to do is go to the back door and co-opt them by running them as is on behalf of that business or the financial analyst. Of course, that could be a tough sell because a lot of financial analysts and people in the finance department don't trust IT to manage their data for them. But a lot of times the analysts are overwhelmed and want to spend more time analyzing data. And in that case, sometimes they're willing to let you take over their spread mark, do all the grunt work in the back end, so they just get the data they really need. Meanwhile, if that happens, IT can gradually renovate that back-end system, populating that spread mark, and migrate them to the BI team standard infrastructure. So that's the co-opt strategy for dealing with spread marks. The coerced method is one of last resort, but it's one that usually has to happen at some point along the line, because often there's no option but to force spreadsheet users to abandon their manual processes and convert to a standard BI platform, at least for some elements of reporting and analysis, perhaps not all. This should only be done once the IT team has proven that the data warehouse is trustworthy and the data inside is accurate. And it usually takes a mandate from the CEO or CFO before people are willing to relinquish their spread marks. So it's a great quote here from Director of BI, the major U.S. bank. For a year, we patiently reconciled our reports with theirs, and we were always right because we had an automated process while they had humans entering data into spreadsheets. After that, the Director of Operations, at my suggestion, issued a mandate saying we would no longer reconcile reports, and everyone who had been creating manual cost reports would be redeployed. So eventually the hammer came down, and people had to convert to the new environment for standardized reporting. I will always say in the ad hoc world, where people are doing ad hoc analyses, so the data may not be in the warehouse, report may not exist that analyzes the situation, you will probably still be using spread marks, but in that case, ideally, they are temporary, exploratory, if you will. So, in summary, leading CFOs are moving their finance departments from the back office to the front office and transforming them from operational accountants to strategic advisors. The key to this transformation is finance's ability to work with the BI team to harness information and become the eyes and ears of the organization. So to leverage BI successfully requires a number of things. Strong executive sponsorship that believes in the value of a single version of truth, that is willing to invest the money and time over years to establish a strong data foundation, and are willing to use and certify the data that the infrastructure generates rather than rely on renegade spread marks. Two, an effective partnership between finance and the BI team, who both understand and respect each other and what each needs to be successful. Three, financial analysts serve on the working committee that oversees the BI program, and they're viewed as critical allies rather than enemies of IT or the BI team. A finance-friendly data warehouse that contains data from all subject areas at a detailed level and applies rules to financial data required by finance. Five, the company standardizes its general ledger and chart of accounts globally and harmonizes definitions of key metrics. And finally, Excel is used as an analytical client, not a data mart that creates silos of information. So that's a summary of the research that I conducted on this topic. I believe today you can download the complete report that has a lot more details. And Linda will tell you a little bit more about how to get that and take us to the next part of our program.
Great. Thank you very much, Wayne. Yeah, that report is available on TDWI's website. You can go there and click on reports and access that, and it's available to everyone. At this point, let's go ahead and move into our question and answer period. We've got some good questions coming in here in the queue, and let's see how many of these we can grab in the remaining portion of the presentation. If you'd like to ask a question of Wayne, this is a great time to send it over. Go ahead and type it in on your console there where it says questions and hit submit, and we'll see it on our screens shortly. Let me start with this question, Wayne. I think it's a good broad one and goes to some of the best practices you've been discussing today. The question is, our biggest challenge is aligning financial and operational data, which I think is exactly what your research has shown. Do you have some more suggestions on where we should go with that?
Yeah, you know, I think when you come down to it, that is the heart of the issue, is combining these two views of the enterprise. And I was kind of surprised when I did the research just how divergent those two views were. And, you know, finance just needs to see data in a specific way. They need to provide apply a lot of rules and transformations to get the data ready for external reporting and for the income sheet. So, and the business to do its job out in the trenches, each department, sales, marketing, and what have you, really doesn't need to apply those transformations. So it all comes down to working together when creating data models for the warehouse to make sure that these two views of the world are linked at a transaction level, at a very detailed level, so that data can roll up either way, either the way business wants to see it or the way finance wants to see it. And the latest data for profit and revenue is calculated the way the company is going to report it for the most part to the external world. Mm-hmm. So it's pretty involved, but it gets down to how do you design the warehouse to start. So it behooves BI folks to bring in the finance folks early on in the process to make sure that the fundamentals are laid down early on.
Right. This is an interesting question, which goes to slide 20, which I'm going to put up on the slide on the screen for the audience. This very interesting quote from someone on a finance team, and this question says, to address this point in the quote about 90% solution being insufficient, what advice do you have about a strategy for prioritizing the data domains that are assimilated into any new data warehouse as it is built over time?
Yeah, that's a great question. I think one of the challenges that we're facing as a data warehousing community is getting all the data that users need in the warehouse in a timely fashion. Mm-hmm. I think the best practice that I've come across, it takes at least 3 months to get a new subject area in the warehouse. And as I said earlier, finance really needs all the data, or else it's going to have to go get it on its own. And some of that data they'll have to get anyway because it might be external to the company. But obviously when you're designing the warehouse, you have to come up with a prioritization of what subject areas you're going to tackle in what order. And really that decision comes down to the business. And the business needs to decide the order. And obviously finance should be a part of that decision, if not driving it. Mm-hmm. Typically, when you start out with a warehouse, you have one sponsor from one department. And obviously, finance is a great place to start. And many companies have started there because they do, as finance, have their fingers into all aspects of the business. So it really is a business decision of where you start and how you roll out what data you bring into the warehouse.
Mm-hmm. Here's an interesting question. Should financial consolidation, forecasting, and planning work by linking directly to GL, to the general ledger, or should data warehousing and data integration platform be in between those?
Well, from what I know, and I'm not an expert in financial consolidation, they'll work directly against the general ledger and bring data back for financial reporting. And which is one reason why finance has always had a different set of numbers, is that they've gone out and gotten, retrieved the data on their own from all the GLs spread throughout an organization. So what I'm advocating here, and what I've seen a number of successful companies do, is make sure that what the finance department rolls up is the same as what the business rolls up within the data warehouse. So you'll still have, the warehouse doesn't replace financial consolidation, and I don't think it really should be in the middle of that process either. It's a parallel process, but we just need to make sure that the warehouse data reconciles with what the finance department is rolling up for financial consolidation and reporting applications.
Mm-hmm. Okay. A question here on the importance of the CFO. This attendee says, I agree that CFO sponsorship is key, but in our early stages, we need their sponsorship first. In your experience, what's the best approach to get their buy-in early on in a project? Well, if they don't intuitively understand the importance of of what the BI team can deliver, it can be a hard row to hoe. Mm-hmm. What I've seen is that most financial officers, especially in the wake of Sarbanes-Oxley, are very much aware of the importance of applying appropriate controls to information and not letting spreadsheets run the company.
So there's been a lot of pain in finance departments around that issue alone, financial reporting to the street and applying appropriate controls. I think most CFOs understand the limitations of Excel and how vulnerable it makes the companies. So I think by nature, CFOs today in 2010 are very much are much more receptive to this whole notion of consolidating information for reporting and analysis using a standardized infrastructure, and are probably a lot more willing to pay for it than they were, 10 or 15 years ago.
Mm-hmm.
And do so on an enterprise basis. And we've always had silos of financial analytical information and marketing analytical information. I think now people are realizing that these silos only take you so far, and they just really just perpetuate the problem on a bigger scale than the spread mart issues. So the key is now to go from spread marts to these departmental marts to really an enterprise view where there's a single version of truth, and you don't spend so much time trying to reconcile data across these silos.
Along those same lines, there's a question on ownership of BI and versus finance. Should we have a position of a strong BI manager or director in finance, or should that be someone separate, reporting directly to the CEO?
Yeah, the alliance and partnership is an interesting issue. I gave some examples in the presentation about how the BI team has been successful in recruiting folks who started out in finance. And I would say there are probably lots of folks in finance who would make good BI professionals, and it may be a good career shift for them, because a lot of these financial analysts and managers are very adept at managing information, and they understand the business. And if we bring them into the BI team, they can really transform how the BI team operates and accelerate the development of new applications for finance, as well as other departments as well. At the same time, I think the BI team needs to have liaisons with every department, people who can stand between business and the BI team at a high level and kind of serve as consultants / requirements gatherers / advisors about how to best leverage the infrastructure that exists. So I think that cross-pollination goes both ways, but it's mostly BI pulling finance people into its team, as well as taking some higher-level BI folks who understand finance and making them very active liaisons to that department, to the point where they're spending most of their time in finance instead of BI.
Mm-hmm. Okay, here's an interesting question on that spread mart issue that you've talked about. Any suggestions on how to get a young corporate finance team who's responsible for a $4 billion company to better understand what real BI is and that Excel is not the answer? At the moment, they think BI is financial consolidations, and they send Excel template after Excel template to collect data. Any suggestions on turning that issue around?
Yeah, it's with young organizations, it's definitely evolution. And I was just talking with one yesterday, pretty much the same boat, where it takes pain before the business realizes that, one, it's grown up and can't run on spreadsheets anymore. It takes some kind of very visible failure or very painful knock to the bottom line before executives begin to look and see in a different direction. So for new companies, they start out by running on Excel and Access, and at some point, and I would say $4 billion is probably big, enough to the point where they should be recognizing that this is just inefficient and they're losing lots of money this way, and they're not helping themselves, they're probably not helping their customers, and they're probably very vulnerable to competition if they don't get their information house in order. But it's a hard one. If the executive's not receptive to it, it's very hard to convince them. I mean, you can bring a horse to water, but you can't always make it drink. And so obviously you need to sell and market as much as you can, find competitors who are effectively using business intelligence, show demos about what could be, what kinds of reports and dashboards could look like, and how they could help the company. A picture is worth 1,000 words. So there are lots of techniques like that to kind of wake people up and make them more aware of the possibilities and potential. But ultimately, either executives get it or they don't. So if they continue not to get it, sometimes the best strategy for you is to find a place with more fertile fields to sow.
All right, let's move on. Speaking of best practices and speed of delivery, Wayne, are you seeing more proprietary, internally built data warehouses out there, or is the trend right now more toward purchased data warehousing platforms?
Yeah, that's an interesting question. I've been tracking that a little bit. Mm-hmm. We've had these packaged applications out there, analytic applications, for a long time, and they really haven't caught on. However, Oracle, one of our sponsors, has made a huge commitment to it, and they seem to be doing very well. And a lot of our other sponsors actually do have select packages here or there, or templates to get people started and running pretty quickly. So I think there's a growing market for packages to speed deployment. I mean, the only problem with packages is you just can't customize them, or else you get into a lot of trouble. That being said, I just did a survey of about dashboards, and asked people if they were building, buying and extending, and more than half, 50 to 60%, for the three different types of dashboards, said they're still building them from scratch, using custom code and programmers.
Wow.
So there's still a lot of custom development out there, which was surprising to me. But that's certainly in the dashboard space, which is a lot newer than packaged data warehouses.
Mm-hmm. Okay. A couple more questions here we have time for. Here's a question from a large organization, a worldwide organization. What's the recommended solution, I guess, for combining BI and finance for a federated financial organization with individual business units, for example, in various countries, with their own COAs and reporting needs?
Yeah, call me afterwards. That's like a custom engagement.
Yeah.
But I think that's a very complex environment, and you can make it work on the back end by integrating things, which takes a lot of time and energy. Mm-hmm. But what I've seen time and again is companies cut through the complexity, cut through that Gordian knot by simply standardizing what everybody's doing on the back end by implementing a single financial ERP globally. It reduces costs, streamlines your suppliers, and makes it a lot more efficient to move data around and get to that single version of truth. So eventually a lot of companies, big companies, do bite that bullet. Usually after years of mergers and acquisitions, they've had enough, and I realized how important it is to get everyone on a standard platform so they can generate standard data from standardized processes.
So a complex process there, it sounds like.
Yeah.
We're just about out of time. Thanks, Wayne, for your presentation today and your answers to all of those questions. I've got one final question. It's for members of the audience. If you can all just take a moment and give us some feedback on the quality of today's webinar. We'd appreciate your insights. That helps us in planning future events. While you're doing that, let me thank Wayne Eckerson, who's Director of TDWI Research, for his presentation today. Also, a special thanks to our sponsors for allowing us to bring you today's event at no charge. Again, those sponsors are MicroStrategy, Oracle, Teradata, and Visual Mining. Also want to take a moment to remind everyone you can obtain a copy of today's presentation immediately through the Click Here for PDF line there on your screen. Also, we'll be emailing each of you as a registered attendee a link to an archived version of the presentation complete with the audio component. And finally, I want to remind everyone that TDWI offers a wealth of information, including the latest research, reports, webinars, and information on business intelligence, data warehousing, and a host of related topics. We encourage you to tap into that expertise. It's all at tdwi.org. And with that, from all of us today, let me say thank you very much for attending. This concludes today's event.